All right, so this is our template that we're going to be using for this video. And this is obviously going to be based on assumptions because we don't have historical data. All right, so in year one, we're expecting to make, well, how many customers am I targeting to have, right? So uh, if we're being realistic, a lot of people drink coffee. So I'm going to say, I'm aiming to have, let's say 100 customers. Do 100 here, okay? It sucks to work with like small numbers, so we're gonna make it a little unrealistic. All right, cool. So now we have our customers, right? So this is in numbers, obviously, because we're aiming to get 1,000 customers in the first year. Now moving on to the average order value. So since we have it is a coffee business, right? It's kind of, sometimes you have different tiers of maybe you purchase the lower quality, or maybe you purchase more. So we need to come up with an average number. So if you have that historical information, you are going to be able to calculate the average, right? But we don't. So let's say our average order value is let's say $40, right? $40, that's our average order value. All right, cool. Now with businesses, there's always going to be refunds, right? People are always going to be, returning things. Maybe they don't like how it tastes. Sometimes you might have, a 30-day refund policy where they can bring it back, in 30 days, or tell you that they didn't like it. Maybe you promise that that's like one of the things you have to do if you're just starting a business. You have to build that trust, right? If you don't have a refund policy, customers are gonna be like, I don't know if I want to do. What if I don't like it, right? So you always want to have a refund policy. So from here on, we're gonna have percentages, right? Because we don't have actual data from the past, so we are gonna be using percentages, and this is gonna be the it's gonna be a percentage of the profit that we have, of the gross income that we have. Um, so all these things over here going down on, except for the taxes, this is gonna be a percentage of the revenue, right? So when I go to refunds here, I am projecting that, or assuming that uh, refunds are gonna be 3% of the revenue for the entire year, right? This is based on the this is an annual basis. This is on the annual basis. So I'm projecting them to be 3%, and I just kept it 3% to go all the way through, just to keep it simple. You can always adjust this later on. You see, as we go on with this. All right, so now we have discounts, right? Sometimes you have to, that's how you get customers. You have discounts, 40% discount, 30% discount, whatever, this much discount. So discounts are, so when it comes to refunds and discounts, these are going to be negative, right? Because you're taking away from your profit, right? These are negative numbers that are coming out of your pocket, right? If you do a refund, that means you're giving the money back to the customer. If you do a discount, that means you're collecting less than what you projected to be the average value, the average order, right? So these are the negative numbers here. So we're expecting to for 5% of the revenue to go to discounts, right? So that's money that we're throwing away. Now, moving on to the second part, which is the cost of goods sold. So first thing we have is going to be the product itself, right? We have to have the product made somewhere, right? I'm not going to be making the coffee or grinding the coffee or anything like that. We're going to have the product, maybe purchase it from a supplier. This is going to be the cost of the product. For this, I have it as 35% of the revenue. That's how much I think it's going to cost. It might go up over time. It might go down over time, but you can always change these numbers here. I just kept it the same for simplicity. Now, fulfillment, this is essentially, shipping and all this and that, labeling, all this and that. This is going to be 5%, right? It might be more, it might be less going on. You can always change these percentages later on. But for now, we're just going to keep it simple, keep it the same and uniform. Now, merchant services, this is going to be, since you are selling since it's an online business, people have to swipe their credit cards, you need payment processing, and it costs money. I think Shopify charges like, I think like 2%, 1%. So they're always going to charge you for those services. So we have merchant services here. Now moving on to the third part, which is operating expenses. That's how much it's gonna cost you to operate the company, right? The business. The first thing is gonna be personnel. So this is, if you hire maybe a freelancer to maintain the website, or if you pay yourself, or if you hire just like freelancers or 1099 employees, things to people. This goes under this, right? Think what it takes to run the company. So I'm projecting this to be 15%. And we also have marketing, right? If you're doing an online business, you need to market. Probably should have made it a lot more, but we're gonna keep it nice and smooth and keep it at 10%. And you also have other, so you want to leave room for anything that might happen, maybe something that you did not account for in your projection, right? You always want to leave a room for that. So for this one, we are leaving 5% of the revenue. We're gonna make sure that this is allocated to anything else that pops up. Now for the tax rate, this is a little tricky, but we're gonna be using. I'm gonna use this one right here. So this is. So this says that the SBA, the Small Business Administration, states that small businesses of all types pay an estimated average tax rate of 19.8. So I'm gonna be using 19.8%. That's pretty average for all small businesses. So I'm gonna do 19.8%. We don't want the. There you go. All right, cool. All right, so now we have our projections. I've described them to you. Pretty simple stuff here. All right, now I'm gonna go to the income statement. So this is where we have our template here that's already built. We just don't have the numbers on here, but it's pretty simple here. On the top we have. Let me go ahead and lock this up here. I'm gonna go to view. And I want to go to freeze out top row. Yeah, that's good. All right. So on the top we have revenues, cost of goods, gross margin, and when we have operating expenses, and we go to our taxes down here. All right, and we end up with our net income. So there's one thing that's missing from here, right? That's usually on a lot of income statements. That's gonna be depreciation. I don't have it on here because it requires another financial statement that I have not built on here, but we're gonna leave that on. We're gonna leave it off since we're operating an online business, right? We have our supplier, we have we have our fulfillment, we have all this and that, so we don't really have things that we can depreciate like that are of significance. Okay, so what I'm gonna do here so we're gonna start off with the revenue here. We're gonna start off in year one. So our revenue is going to be based on, we don't have any prior data from the past that we can use. So we're going to be using our assumptions to do this, right? So I'm going to do equal sign, go to our assumptions tab, and I'm going to multiply the customers, right? We want to have 1,000 customers. I'm going to multiply that multiply by the average order value. So that's the importance of knowing, the customers that you're targeting to get and the average order value. So if you've never sold anything, you can literally calculate this by calculating the average of the products on your website, and you can kind of like use that number. So when I multiply that by 40, there you go. So that means we're gonna be making 40,000. So pretty simple. 1,000 times 40, that's 40,000. Okay. All right. Now for the next part, this is gonna be the refunds part. So how much are we gonna refund? So for this one, we'll do equal sign, and we'll do a negative amount. Actually, escape. So equal sign negative, because this is gonna be a negative number. This is taking away from our revenue. Okay. Now I am gonna select this right here, the 40,000 that we just made, and I'm gonna multiply this. Go back to assumptions by our projected refunds, right? 3% of the revenue, which is this multiplied by this. There you go. So we're expecting to refund 1,200. Okay. For the discounts, we're going to do the same thing, equal sign negative, and I'm going to multiply the 40,000, go back to assumptions, by the discounts, right? 5%. Actually, hold on. 40,000 multiplied by discount. Well, this needs to be a negative number actually. That's why you don't want to do this live. I'm gonna change this to dollars. Okay, there you go. It was in percentages. Let me go ahead and make this a little bigger. Double click. Okay, cool. All right, so now we have our revenue, we have our refunds and discounts. Now, so to get the net revenue, we're gonna take how much you made to begin with, or how much you're projected to make, and then we're gonna subtract the refunds and the discounts, right? Because we're not making that money; it's going back to the customer. So I'm gonna do you can do a simple sum formula here. Sum at this. Now we have $36,000 left, right, for the first year. Now I can just extend that formula over here. All right. So 36, 73, 110, 184. So this looks good, but you haven't accounted for everything yet. Okay. So a lot of people that start businesses, they think that, however much is in the account is how much is gonna, how much they project to make after refunds and discounts, or maybe just refunds, is their actual profit. But that is not your net income. That's where we're trying to get to, the net income. All right. Now we're gonna go to the product here. So for the product itself, this was, if we go back to the assumption, this was going to be 35% of our revenue. So I'm gonna go back to the product. All right. So we're gonna go ahead and select our net revenue, right? We're not using this anymore because this is an inflated number. When we have this, we haven't taken into account the refunds and discounts. So we're gonna be using the net revenue, right? Not the gross revenue. Net. And I'm going to lock this cell by pressing F4 twice. It's going to lock it. I'm going to go ahead and multiply by the product. Okay. Okay, cool. So this is 1200. All right. I'm going to go ahead and extend this. There we go. I don't like using a lot of shortcut formulas or shortcuts because, you don't really see what I'm doing. I've watched a lot of tutorials on YouTube where people are using a lot of shortcuts, keyboard shortcuts, where you don't know what they're doing. Where are you clicking? So I'm not going to be using a lot of those on here, but I might slip and use a few, but I'm going to try not to. All right, so this is how much the product is going to cost us each year, okay? Now, let's look into the fulfillment. For the fulfillment, that is going to be, shipping and packaging, all this and that. We're going to combine that into one. Okay, so this is going to be, grab this. The net revenue again, I'm going to press F4 twice. That's going to lock this cell so it doesn't shift when I move the formula. All right, so I'm going to go ahead and multiply that by our 5% that we have projected. And I'll do the same thing for merchant services, okay? Shoot. Multiply that by our 2%. It would probably be more, honestly, more than 2%. I don't know what happened here. I would put it at like 3%, I'm pretty sure. If you're using Shopify, it might be more if you don't have the premium plan. All right, so I'm just gonna go ahead and extend the formula here. All right, so now we have our cost of goods, right? So sometimes you might have more. This is just relating it to this business here where we have, the only things you have to worry about is the product fulfillment and merchant services. Now, if you had more things, yeah, you definitely have to add on here, okay? Now for this same formula again, so COGS or COGS, this is the total cost of goods sold, right? We're gonna do a sum formula, just add these amounts here, right? Add these. Actually, I did a shortcut there. So you just do like sum, open parenthesis, you can select all of this, and you can close it. There you go. That's how you do it. Where you can just, all right, cool. Now we have our cost of goods sold, right? Now look at this. We had 40,000 right here, and it's gonna cost us what, 15? Jesus. All right, cool. Now we're gonna go ahead and calculate the gross margin. So the gross margin is gonna be how profitable you are, right? Before, when you take into account the net revenue and the the cost of goods sold. So this is simple. So you do equal sign and you subtract your net revenue, right? That's how much you have after refunds and discounts, and you subtract the total cost of goods, right? Go. Now you have 21,000. You see that? Now your pockets are getting thinner because you thought you had 40,000 to begin with, right? You're like, oh, I give refunds and discounts. Oh, now you have 36,000. And then you do all this. I only have 21,000. All right. That's the first year though. Um, sometimes it's perfectly fine to operate in the negatives if you are, trying to gain a lot of customers, because this is assuming that we have 1,000 customers, right? And if you are trying to get as many customers as you can, you might have to lower your prices before you even get to that level. All right. So moving on to the third part here, which is going to be the personnel. So this is, freelancers. Maybe you have, maybe you hire, maybe you pay yourself as a 1099 employee, or something along those lines. Just anything that requires, HR type things. All right, so let's go ahead and do equal sign, and we're gonna grab our gross margin. So this is what we have after, we take away. This is the difference between the net revenue and the total cost of goods, right? I'm gonna go ahead and I'm gonna lock this F4, click this twice, press that twice, and I'll multiply that by our projected, right? So I'm projecting to pay freelancers, maybe myself, maybe 15%. It could be more, it could be less, but for this, we're gonna rock with 15%. Okay, cool. All right, so now we are. I'll move this over here. Okay, cool. Marketing, like I said before, if you're running an online business, marketing is gonna be your best friends. Your best friend. You need good marketing. Okay, F4 multiply by marketing, and then we also have other. So this was, I believe, 5% or something like that. Okay, said F4 twice. No, multiply that by our thing was the other, yeah, 5%. All right, there you go. I'm gonna go ahead and just drag the formula to the right, and same thing over here. We're gonna go ahead and hit or do the sum formula, or you can use the keyboard shortcut, which is Alt plus and equal sign, right? That does it for you. You just drag the formula here. All right, there you go. Cool. All right, so now we've built our essentially revenues and expenses. That's what we've done here. Actually, if you want to do a percentage of, a lot of people like to have, what is the percentage of my gross margin? So for this, you could just do the 21. You could do equal sign the 21,000 divided by the net revenue here. That should give you a percentage, okay? And you can change this to percentage if it's not already in percentages. Cool. All right, so once you've done all this, our next part is gonna be the operating income. So that's gonna be how much we so this is gonna be the difference between the gross margin, which we got by subtracting the cost of goods sold from the net revenue, right? That is our gross margin, right? How much we're actually making after removing the cost of goods. Now, for operating income, we need to actually get. We're gonna be getting the do equal sign. We're gonna get the gross margin, which is 21,000, and we're gonna subtract the total operating expense. Okay, because we have not taken this out of how much we are looking at as profit at this point, right? So now we're taking out the personnel, marketing, and other. Take that out. Now we only have 14,000 left. Okay, I'm gonna drag this formula all the way here. Make sure it's good. All right, cool. Now for the interest, right? This is gonna, if you have any loans, any things like that, we don't have anything like that here. So for this example, I'm gonna go ahead and put 0% when it comes to this. We're not gonna mess with any interest here, okay? So we're not gonna be messing with it. So we don't have any interest. So now if you had interest, right, you'd have to take that out, right? So it'll be equal sign. You would take the operating income and you would subtract the interest, if you had any interest, right? You get that from the balance sheet, I believe. If I'm not balance sheet, I believe. If I'm not mistaken, I think that's where you get it. So if you had like $20,000 in interest, then you'd be in a negative, right? That you have to pay. But we're assuming that we don't have any interest on here. Okay. All right. Cool. Now this is our. Let me just make this bold. Now this is gonna be our how much we have after we pay off our interest. That's before taxes, right? We haven't taken taxes into account. So there's a lot of things you got to do here. So a lot of people don't take into account maybe if they get a loan to start their business, right? You have to pay interest on it. Maybe you might not be actively paying it, but it's getting charged, right? So that's how you end up paying a lot more, right? Simple finance. You also they don't take account, when it comes to taxes, right? The end of the year comes, they didn't file their quarterly taxes. I'm gonna wait until the year ends, and then boom, now you owe more than you have left, right? So you want to try to project these things. That's the importance of projecting these income statements. All right. All right. So for the taxes, we said we're gonna be using 19.8%, right? This is based on, we said it's a small business. So it's based on the SBA, right? Which is the Small Business Administration. And they say the average is 19.8. They said for sole proprietorship, it's like 13.3, and then 23, and then 26 for S Corp. But for this, we're using the average 19.8. Go back to my video here. Oh, there you go. All right, so for taxes, we are gonna do equal sign. We're gonna take our net income, that's the NI here, before taxes, right? And we're gonna multiply this by our tax rate, which is 19.8%. Okay. So much we owe. All right, there you go. See, the more you make, the more you owe, right? So this might, be, if we're being realistic, sometimes you might find, loopholes. If you get a good accountant, you might be able to pay less. But it's good to be realistic, this so you know what to expect. If you need to find an accountant, it's going to help you lower that amount. All right, so finally we have the net income here. So the net income is going to be the amount that we had before taxes, right? And then we subtract the actual taxes because we'll pay them off, right? Pay the taxes off. Now we have 11,000. So let's go all the way through here. Boom. There we go. So now this is our income statement forecast. This is misspelled. Income statement forecast that is projecting 5 years. Like I said before, these assumptions, the beauty of this is dynamic. You can tweak the assumptions here, right? So let's say let's do something crazy. Let's say here we get 10,000 customers. If I go here, you're gonna see that these numbers adjust. I have $400,000 now. They all adjust. So that's how dynamic this is. That's the reason I call it a template, because you can always change these assumptions, right? When they become reality, you can always, change this to, more years here. And you can actually replace this with the actuals, right? A lot of people like to replace, they have projections and they'll add an actuals column where they have the actual numbers as they happen, right? The year is over, they compare their projections or their forecast to the actuals, right? And then they look at the difference. It kind of like helps you analyze. If you're a financial analyst that's doing something like this, it helps you analyze the trends or how accurate your model is, right? Or your template is. So these you can always adjust, right? They say after the first like 3 years or the first 5 years, we realize that, you calculate the average. Oh, we're actually selling more than we thought we were. It's actually $60, on average, right? So you can really just adjust this. Oh, shit. You can really just adjust all this and you see that the numbers will change as well, right? So that's why this is dynamic, right? You don't have to mess with this part here because it's already done for you, unless you wanted to add, if you have new cost of goods, like, that can affect this formula here, you can, tweak this. Or if you want to add more things, like if you get a loan, if you get a small, what is it, a PPP loan, right? And there's interest on it. I think those are interest free. They don't have any interest. You can add that interest percentage here. You can add it to your assumptions actually, and you can just multiply. It's always gonna be a percentage of the revenue because that's the driver in everything, right? So if it's a subscriber based business, you might want to take into account how many you assume you're gonna lose or you project on losing, right? Because if someone subscribes to a service, some people usually cancel. If you have a free trial, after the free trial, they'll cancel, or maybe they just don't like it, so they're gonna cancel. So that's something you might need to include on here as is a negative amount, right? Because it's gonna be not a negative amount, but like it's good to keep track of that number. And there's really no way of knowing this until you've actually operated the business and you have kind of like average, you have data to kind of like to build your assumptions on. But it's hard to, maybe people love it so much you have zero unsubscribers, right? So yeah, so that's really the main. So I tried to use things that weren't too specialized, things that were more general, right? That you can always add more things on here. Yeah, so this is the template here. I have a link in the description below if you want to get the template. If you want to get that, it's not free. It took me hours to make, and it's definitely gonna save you time to make. That's the beauty of this because you can't really, you don't have to mess with all of this, right? Unless you're adding more years. Yeah, let's say you want to add more years. Let's say you've been operating for 5 years, you figure out some good numbers, but you want to continue this as a business. You can always continue with this, right? The more data you have, that's actual, right? A lot of people separate the actuals from the projections or the forecasted numbers, right? The more data you have that's actuals, you can replace this with the actual numbers. Now you can base your future projections based on actual numbers. Anyways, the template, there's a link in the description below for the template itself if you guys want to get that. It is not free because it took me a couple hours to make. Thank you so much for watching. I'll catch you guys on the next video.